A very good morning, friends. I hope you're all doing well. And most importantly, I guess you've made a cumulative revision of what we have covered on Indus 103 so far. Well, I think before we take it further, let me just remind you that we were discussing the concept of acquisition accounting, and I was giving you a 7-step model as far as acquisition accounting is concerned. So I think let's do a little warm-up exercise. I hope you've made a revision as well. But I think before I take it further, let's do a quick revision of the 3 steps I've covered so far. Then I'm going to take you to the very important step today, and that is the computation of the purchase consideration, which is step number 4. Step number 5 and 6 is not technical at all. It is pretty simple and straight indeed. And we should be able to cover up maybe a comprehensive question also on the concept of acquisition accounting. So I think let's start with a warm-up exercise for the day. And I think let's just give you a little inputs. So good morning once again to all of you. So I think let's begin the journey. So let's do a little mind mapping on what we have learned on the acquisition accounting. Well, in the previous class, I started with the concept of acquisition accounting, and I gave you that we're going to follow a concept of 7-step model. Let me also remind you that when there are a business combination, I would say it is between unrelated party or it is between related party. If the transaction is between a related party, then it falls under the purview of common control transactions. That is Appendix C, which we are yet to discuss. But when it is between unrelated party, it could either be a case of acquisition accounting or it is a case of reverse acquisition. We're yet to discuss the accounting for the acquisition, reverse acquisition as well. So the common control is what we're going to discuss later. And reverse acquisition, what we're going to discuss later. Right now, the focus is a transaction between unrelated party and it results in acquisition accounting. To remind you, the concept of acquisition accounting would apply when the legal and the accounting acquirer is same. So if somebody will tell me that, please tell me in single liners, where acquisition accounting or where a reverse acquisition or a common control transaction applies, I would put it like this. Now hear this very carefully. If there is a transaction between unrelated party and the legal and accounting acquirer is same, it results in acquisition accounting. If there is an unrelated party transaction and in this case, the legal and accounting acquirer is not the same, it results in a reverse acquisition. So mind the words carefully. Unrelated party where legal accounting acquirer is same is a acquisition accounting. Unrelated party transaction where the legal accounting acquirer are different results in a reverse acquisition. And if it is a related party transaction, automatically it would mean a common control transaction. Now, establishing whether it is unrelated or related party is something what we're going to see when we come to the common control transaction, which will help you to decide when you go to attack a complete question in itself, whether it is unrelated, whether it is related. And if it is unrelated, is it acquisition or is it a reverse acquisition? I hope this helps. So when we're looking in terms of acquisition accounting, I would say in this case, it is supposed to be an unrelated party transaction. That is one. So once you reach to the conclusion that the transactions are between unrelated party and also in this case, the legal and the accounting acquirer are the same person, then we can say it is definitely a case of acquisition accounting. Then we decided that the entire acquisition accounting is going to be divided into a 7-step model. And what we've covered so far in terms of the 7 steps is the 3 steps. The step number 1 focuses on identifying the accounting acquirer. The step number 1 focuses on identification of the accounting acquirer. Well, in this particular case, you've got 3 major conclusions. They've given you the chart, but there are 3 major conclusions what you need to keep in mind. Number 1, you need to basically look into the fact that the purchase consideration is primarily in cash or the purchase consideration is primarily in equity shares. If your purchase consideration is in cash, it doesn't make a difference to me whether you've created a new entity or not for the purpose of the deal. So the moment the purchase consideration is in cash, one thing is pretty clear. It is always a case of acquisition accounting. The legal and the accounting acquirer in this case will always be the same, whether a new entity is created or a new entity is not created. And the moment you say the consideration is in equity shares, then you need to be careful that did you create a new entity or not? In this particular case, if a new entity is not created, in this particular case, it depends. You'll have to do the evaluations and decide whether it is acquisition accounting or a reverse acquisition. Typically, we decided you need to look at a percentage post-business combination. You need to see what is the percentage of the legal acquirer pre and post-business combination. If the percentage drops in such a way that you lose a control, then it's reverse acquisition. But if the percentage dilutes, but you still retain a control, then it is acquisition accounting. So everything depends upon the percentage pre and post business combination. But in this case, if a new entity is created, it is undoubtedly a case of reverse acquisition. So you can see that if the consideration is in cash, it is undoubtedly acquisition accounting. If it is equity shares and a new entity is created, undoubtedly a reverse acquisition. And if it is equity share, depends whether a new entity is created or not. Okay. Now, coming to the step number 2, that is the focus step number 2, we are getting the date of acquisition. Well, trust me, in a larger question, it would not be an issue. Getting a date of acquisition is not going to be a concern because it is going to be very clearly given in the question. But if you get, let's say, a smaller kind of a question, or maybe a question which is an MCQ, where the examiner tests your knowledge on the date of acquisition, your focus needs to be clear that there is a difference between a date of acquisition and a closing date. Technically, there is a difference between the date of acquisition and a closing date. In a very idealistic situation, we can say date of acquisition and the closing date is equal. The date of acquisition is when you obtain a control, and the closing date is when the purchase consideration is paid. But there are certain exceptions which we saw that date of acquisition could precede. So we saw certain exceptions that the date of acquisition could precede the closing date. The acquirer could get a control over the acquiree before the date of acquisition itself, and that's going to be possible. You can say you need to consider that there has to be a written agreement between the two parties. The acquiree must, by a written agreement, must by a written mutual consent agree that yes, you can control me before the purchase consideration is paid. So if there is a written agreement, you need to be careful that does this written agreement require an approval or not? Or maybe it does not require any approval. Well, if there is a mutual agreement between the acquirer and acquiree, and this agreement does not require any approval, you can definitely say that date of acquisition is going to be before the closing date, before the consideration is paid, you're going to get a control. But if there is an approval which is required, you need to dig in further and see, is this approval something which is a mere formality? Is it something which is a mere formality? What we say is procedural in nature. You just need to get an approval and that's it. I mean, it doesn't mean that if the approval is not made, the acquisition cannot happen. So if it is merely procedural in nature, the date of acquisition again is going to precede, is going to be before the date, the closing date itself. But in a situation, the agreement, the consent required is something which is substantive in nature, something which is major in nature. then in this particular case, the date of acquisition and the closing date is same. It cannot proceed in this particular case. We did a couple of examples giving you an insight in terms of deciding whether the date of acquisition is before it precedes the closing date or not. And that was the focus in terms of step 2. So now I think if you get independent questions on step 1 and 2, I think you can easily handle them. Then I went forward and I made a deeper discussion in terms of step number 3. And that's again a very crucial step indeed. And to remind you the inputs on step number 3, we said your step number 3 is going to be divided in terms of 2 parts. When you're going to consider the step number 3, there are going to be 2 parts in this case, the step number 3A and the step number 3B. Now, step number 3A is purely an exercise which is based on IND AS 12. Now, what you need to do carefully in terms of step number 3A, you need to apply the concept of IND AS 12, and I would advise what you should do. Organize all the assets and liability whose fair value now becomes a book value, mind you. Organize all the assets and liability whose fair value becomes a book value and the tax base is different. So organize all the assets and liability where you know that the book value, which is now equal to the fair value, is not equal to the tax base. The moment you read the question with the additional information, you will be able to get an idea that, okay, these are the assets and liability where the book value, which is the fair value, is not equal to the tax base. In this particular case, apply the concept of IND AS 12. And to remind you, for assets, if the book value, which is now the fair value, is greater than the tax base, it results in a taxable temporary difference. I'm just reminding you the concepts of IND AS 12, where the book value is more than the tax base. It means a taxable temporary differences resulting in a creation of a DTL. And vice versa. And vice versa. That means if the book value is less, then it means a deductible temporary differences resulting in a DTA. And trust me, as far as liabilities is concerned, 100% reverse as far as assets are concerned. Your book value is more, it's a deductible difference resulting in a DTA and vice versa. So once you're able to organize for all those assets and liability where the book value, which is now the fair value, is different from the tax base, you're going to get a deferred tax asset or liability. So organize the DTA DTL if the tax rate is given. So this step is going to trigger only if there is a tax rate which is given in the question. So this is one exercise you must do when you start off the step number 3A. Look at a tax rate is given. Look at the list of all the assets and liability where the fair value and the tax base is different. Get your deferred tax asset and liability. Next, the step number B is organizing a list of net assets. And one thing very clear, when you're organizing this list of net assets, be careful that in terms of this list, the DTA DTL, which you've created in step number 3A, also needs to be incorporated. So this list of net assets is including, it is supposed to be including the DTA as well as the DTL, which you've identified in step number 3A. So you've already organized the DTA DTL, just take care of that, and that's also to be incorporated in the list. Now, we went into a little detail and we gave you that when you go to create this list of net assets, there are going to be certain fundamental principles you need to keep in mind. So let me also give you a quick recap of that before we go further. Now, in this particular case, when you're making the list of net assets, you need to remember the basic principle is that you need to consider all the assets and liabilities at a fair value. So the basic principle is what is there in the acquiree's balance sheet is going to be a part of the acquisition entry. So what is in the balance sheet of the acquiree is a part of the journal entry at a fair value. So I can say the different permutations and combinations could be: you look at the balance sheet of the acquiree, you look at the balance sheet of the acquiree, and there is an asset and liability which is already appearing. So would this appear in the journal entry in the books of the acquirer? Yes. And this is going to appear at what value? This is a fair value. This is a basic principle which you need to keep in mind. This is the basic principle. So this is the basic principle which I have given you. So this is supposed to be the basic principle which we are following, that what is in the balance sheet of the acquiree is going to appear in the entry at a fair value. This is the basic principle. But then we saw certain exceptions coming in. And there were a total of 8 exceptions which I gave you. And even if you don't remember whether it's a recognition exception or it's a measurement exception or it's both a recognition and measurement exception, it's okay. You just need to remember the 8 exceptions. That is important. Which falls under which exceptions may not be very important. Okay. The exceptions which we discussed were a total of 3 categories of exceptions. To conceptually remind you, the asset and liability is appearing in the balance sheet of the acquiree. It is to be shown in the entry, but not at a fair value, at something other than the fair value. This is what we call a measurement exception, that you are considering it as a part of the entry, but not at a fair value. And typically, I'm saying typically, you're going to find non-current assets held for sale. You're going to typically find non-current assets for sale where it is taken at a net fair value in the acquiree's balance sheet, and it continues to be taken at a net fair value in the journal entry as well. That's one of the major exceptions to be kept in mind. Now, something is not in the balance sheet of the acquiree, but is taken in the entry and is taken at a fair value. So which means not in the balance sheet, but is a part of the entry at a fair value. And this is typically, you can say, contingent liabilities, and I would say indemnification assets. So I would say the most important out of the 8 items, the most important in the list is the contingent liability, where you need to consider if it is a present obligation and the fair value can be measured. Any obligation which is a present obligation with a fair value can be measured is supposed to be taken as a part of the entry. And as far as indemnification assets are concerned, if you take the contingent liability, you take the indemnification asset. And number 2, the indemnification asset cannot exceed the value at which the contingent liability is taken in the entry. So typically, these 2 important. I'm just giving you the important items out of those 8. So the total exceptions are 8, but I'm just reminding you the main exceptions which you can confront in the question. The third area is it is not in the balance sheet. It is to be taken in the entry, but not at a fair value. And in this particular case, we saw a plethora of exceptions. Income tax is one of them which you've already taken. So these are the exceptions, and majorly, these are the 3 exceptions which you're going to confront. Apart from this, we gave you income tax, which is taken as per Ind AS 12. That you've already organized in step number 3A. The deferred tax asset liability is taken as per Ind AS 12. Then we saw that if there is any assets and liability related to employee benefits, you will consider Ind AS 19. So any assets and liability related to employee benefit standards, that is a plan assets, a provision in terms of gratuity, etc., all Ind AS 19. Then if there is any assets and liability related to leases, you got to consider as per Ind AS 116. So the respective standards would apply to these items. So these 3 and these 3 makes it a total of 6. And then I gave you some two more items which I said we'll discuss today. I gave you one is the concept of reacquired rights, which I'm here to discuss. The reacquired rights, which I'm going to discuss in terms of step number 4, it is pending. And a share-based payment awards. So this is a pending list, which I will be discussing today in terms of step number 4. So that makes it a total of 8 items on the list. One is the contingent liability, indemnification assets. Then you can say non-current assets held for sale, employee benefit asset liability, leased benefit asset liability, income tax as per the relevant standards, reacquired rights, and the share-based payments. So that gives us a summary view in terms of what we've done in 3 steps. I think it was a little necessary. I might have spent around 15-20 minutes on this, but I think it was necessary to give you a capture in terms of things. For those who made a revision, I'm sure this would have been icing on the cake. And I think if those who have not done a revision as well, I think this would have helped them quite a lot, right? Okay, so that was a warm-up exercise before we take it further. Okay, Shruti sir, thank you sir. The detailed summary. Can you please do illustration 9 from the study material related to the date of acquisition? Small question, finding it difficult. No problems. I'll do that very soon. But can we just defer that a little later so that I can start my step number 4 first? I'll come back to that. Not an issue. Okay, I think Tanisha, you said, so these examples like income tax, employee benefits, leases are example of the third exceptions. Yes. Even if you don't remember, which exceptions is falling under which category, it's okay. But you rightly said it's a part of the third exceptions, that is recognitions and the measurement exceptions. Okay. So this was a warm-up exercise. And before I forget, let me tell you, though it was not in the schedule, tomorrow we've got an extra class for Index 103 because I thought, let's do a little more extensive questions also with you. So there is going to be an extra class tomorrow as well, so that we get one extra class on business combination. So Sunday, tomorrow, and then Tuesday, we finish with this particular standard. So we get a little more extra time. So that will give us a good gripping. I will be able to do some larger practice questions also with you on this area. Okay. So far, so good. Now let's start the journey in terms of the step number 4. Very crucial. Very crucial. Now, friends, hear me very, very carefully, because what I'm going to give you in step number 7 is going to be a comprehensive position. You can do larger questions with this. I made a complete deep insight in terms of the purchase consideration, and I made a list of issues, and this is a list of 7 issues which you need to keep in mind. So we'll be discussing all those 7 issues with you. So let's first give you a chain of thought in terms of the step number 4, that is a calculation of the purchase consideration. Now, please hear this very carefully, because this is one of the most crucial steps as far as all the 7 steps are concerned. Now, when you calculate a purchase consideration, we can say generally the purchase consideration could be in cash and it could be in the form of equity shares given to the shareholders of the acquiring company. Generally, in most of the questions, you will see that acquirer pays a consideration in cash and it also issues equity shares to the shareholders of the acquiring. When you consider the equity shares, you need to consider the fair value of the equity shares issued. So we're going to consider the fair value of the equity shares issued. So purchase consideration simply is the sum total of the cash given and the fair value of the equity shares given by the acquirer to the shareholders of the acquiring company. Done. Now, apart from this, there will be a total of 7 issues which you can confront in the calculation of the purchase consideration. So let me give you a list of those 7 agendas. Now, I'm going to give them some beautiful nicknames. One is what I call DC. And number 2, I call CC. And number 3 also CC. This nicknames I've given so that you can remember things easily as well. DC, CC, and again CC. This is CCS and this is CCE. Don't get worried on what it is. I'll explain, but I call it as DC. DC is called deferred consideration. DC is called a deferred consideration. You can start noting it down as well. So DC is what we call a deferred consideration. Then the next is CCS. This is called contingent consideration. This is called contingent consideration. And when I say S, it is a contingent consideration paid in the capacity of the shareholder. It is a contingent consideration which is paid in the capacity of a shareholder. So I call it as CCS, contingent consideration paid in the capacity of a shareholder. Then we've got CCE. This is called contingent consideration. This is called contingent consideration. And this is E. E means the capacity of employee. Don't get worried. What exactly is this? We will understand the details with examples, everything. So this is called in the capacity of the employee. So we've got a DC, deferred consideration, CCS, contingent consideration in the capacity of the shareholder, CCE, contingent consideration in the capacity of the employee. 3. Next, we've got number 4. I'm just making a list of items right now. Number 4, I call it as TC. Cute names: DC, CC, S, CCE. Then there is TC. TC is what we call transaction cost. TC is what we call the transaction cost. That is number 4. Then number 5 is what we call PHI. We call it as a PHI. That's called a previously held interest. You heard this term earlier as well when I came to the concentration test at the start of the standard. So PHI is called previously, it is called previously held interest. It is called previously held interest. The investor, the acquirer, already had a certain percentage in the acquiry. Before he obtained a control over the acquiry, he already had a certain stake. Maybe he was a passive investor, or maybe he had a significant influence, and now it's getting converted to control. Number 6 is SBP, the pending issue in step number 3. Share-based payment, SBP. So SBP is what we're calling as share-based payments. That is what we call the share-based payments. So that is the item number 6, share-based payments. That is item number 6. And finally, the item number 7 is what we call pre-existing relationship. The 7th item is what we call pre-existing relationship. So there are a total of 7 agendas which we need to discuss as a part of the purchase consideration. We'll be discussing each one of these components in a detail because you can get a comprehensive or maybe a good questions on any one of the agenda. There is a possibility, it has been in the past as well, that you're given just a question on one of these 7 issues independently. So we'll be discussing each of these issues in a detail. So there are a total of 7 issues which you need to confront when you calculate a purchase consideration. So simply remember the list. It is DC, deferred consideration, CCS, contingent consideration, shareholders capacity, CCE, contingent consideration, employee capacity. Then it is TC, transaction cost, PHI, previously held interest, share-based payments, SBP, and a pre-existing relationship. Don't get worried on what are these components. We'll understand them in detail. Okay, so with this inputs in hand, now let's discuss each of these issues. Now, friends, there is another important agenda. I want to give you that agenda right away, because as we go to discuss these agendas, it is going to be very important that you get your frameworks correct. So what I'm going to do, before I do the discussions of these 7 steps with you, let me just take you to the step number 7. The journal entry is the step number 7, and let me give you the thought process which you need to keep in mind when you're going to look at these 6, 7 issues. Now see what you're going to do. I'm just taking you out and I'm taking you to the step number 7, because we are at the end of the day working towards a step number 7. Because at the end of the day, all these steps which we did is towards a step number 7, which I gave you in the last class. The step number 7 is putting a journal entry in the books of the accounting acquirer. Now, I would say when you're putting a journal entry in the books of the acquirer, I would say the journal entry can be of 3 categories. Please watch this carefully and understand this carefully. So when you're looking at a journal entry in terms of acquisition accounting, I would say there are 3 entries. One is the entry which you need to pass. So one is the entry which you need to pass before the date of acquisition. So one set of entries which you need to pass before the acquisition date. I did not give you this in the previous class. Last class, I only gave you an entry which is on the acquisition date itself. Now today, I'm saying that in step number 7, you're going to see entries segregated into 3 different parts. The entries which you're going to do before date of acquisition, the entries which you're going to do on date of acquisition, and the entries which you're going to do after the date of acquisition at a later date. So the focus is in terms of entries being done at 3 different stages. So one is the entries which you're going to pass before the acquisition accounting. One is the entries which are done on the date of acquisition, and one is the set of entries which you're going to do post acquisition. Now, if you focus in terms of the entry on the date of acquisition, I gave you the entry assets are going to be recorded at a fair value. Liabilities are going to be recorded at a fair value. The purchase consideration and the NCI is going to be recorded based on your computations done. You've organized these net assets in step number 3. You're going to organize the PC in step number 4. You're going to organize the NCI in step number 5. And you're going to get a goodwill as a balancing figure, which is based also on step number 6. This is what I gave you, that you put an entry. Now, before this entry, there could be certain entries which are done at this stage. Now, let me connect you very appropriately at this stage. The list of 7 issues which I've given you could impact entries before or could impact entries after acquisition date. Mind the words carefully. The list of these 7 issues could have an impact that you might have to put entries before acquisition date, or the issues may impact the entries post acquisition. For example, just giving an example, when I say a pre-existing relationship, there is a possibility that there is a common debtor-creditor relationship between the acquirer and the acquiree. So if sorry. So if there is going to be a debtor-creditor relationship between the acquirer-acquiree, we're going to call it as a pre-existing relationship, which means I am going to put in entries for pre-existing relationships at this stage. Now, what entries are going to be passed is what we're going to see later. The idea is only to expose you that as far as the 7 issues are concerned, some of these issues could trigger that tells you that you need to put an entry before the acquisition accounting. So if there is going to be a pre-existing relationship, it could impact an entry before the acquisition date. Similarly, if you look at entries which might be done post the business combination, I mean, the concept like DC, the concept like a contingent consideration could impact the entries after the acquisition date. Because if there is a deferred consideration, which means it's going to be paid later, there will be entries done at a later date as well. So to give you a few examples, you can say, for example, a deferred consideration. For example, a contingent consideration paid in the capacity of shareholders or employee could impact entries after the date of acquisition. So for complete clarity, when we're going to discuss these 7 issues with you, your mind needs to be very clear on the thought that this issue doesn't impact the entries before, on, and after acquisition dates or not. I hope you're getting this correct. That's a very crucial importance. Your step number 4, which is relating to the purchase consideration, is got a list of 7 issues. So as I discuss the 7 issues, you need to be very clear that this issue, will it consider an entry pre-acquisition, on the date of acquisition, and after acquisition date? Because we cannot do these discussions at a later stage. It is at this stage when I discuss the 7 issues with you, you need to be clear that, okay, this issue impacts the entry only on acquisition date. Okay, this particular issue is going to impact entry on and after acquisition date. Okay, this particular issue is going to impact entry pre and on the date of acquisition. I hope, friends, you've got the inputs on what I'm saying. I hope I'm very clear on my thought processes at this stage. Okay, that's great, Tansha. And Mansha, you said, so indemnification assets are recorded as a part of the recognition and measurement exceptions. Are these at a fair value? No, they're not at a fair value, because indemnification assets will be restricted to the extent of the contingent liability value. And as I said, don't get worried, even if you're not able to remember that this is a recognition exception or this is a measurement exception, you should be able to identify that, okay, this item is to be considered at what values. That's it. So you may not be able to categorize the category. That's perfectly okay. Okay. And I think, Uday Pratap, you said, so where do I get your material? Well, you can download this on the ICAI. When you go to the access on the portal, there you get all the PDFs, the class notes are uploaded out there. So you'll be able to access it on the portal. Okay, now let's, I think, come to the discussions of these issues. I'm now going to discuss these issues one by one in detail. Okay, do you all know the concept of UOD, unwinding of discount? Please give me your inputs on the chat box. Are you all aware of the concept of unwinding of discount that is called a UOD in terms of Ind AS? Unwinding of discount, I'm sure you know that. But I think still on a very safer side, let me get your details. Are you aware, friends, on the concept of a UOD, that is unwinding of a discount? Yes. Okay, Suraj tells me no. Okay, I think maybe you may not remember the technical term. Let's begin. I'm starting with, first of all, the issue number 1. I'm starting with the first issue number 1, and that is called a DC. That is called a DC, that is a deferred consideration. Now, one thing, friends, I would like to tell you, many of you may know it and many of you may not know it, but let me give you a golden rule in terms of Indian accounting standards and see what the golden rule is. When you apply the concept of present value, I have to receive something in the future. You apply the present value concept, that if I receive the money today, what is the present value? If I have to pay something in the future, then I say, okay, let me apply the present value concept. If I pay the money today, what is the present value? So the concept of present value is applicable in 2 cases. I need to receive something in the future. If I receive today, present value. I need to pay something in the future. If I pay today, what is the present value? Trust me, in Ind AS, whenever you apply the concept of present value, it is called discounting. I need to pay something in the future. So what I will do, present value. If I have to receive something in the future, if I receive today, present value. The moment you apply the concept of present value, you call this as discounting. And trust me, the golden rule is if you apply discounting, it'll definitely lead to what we call unwinding of discounting, the opposite of discounting called compounding. I'll explain. What is a deferred consideration? A deferred consideration is something which will be paid later. Because when you pay a consideration to the shareholders of the equity, you pay something today and you promise to pay something later. But remember, when I say a deferred consideration, it is something which will be paid later. That is one. And it will be definitely paid. And it will be definitely paid. So it is not that you're going to say that it's may or may not be paid. When I say it may or may not be paid, but depending on conditions, it is contingent consideration. The difference between a deferred consideration and a contingent consideration is that deferred consideration is something which will 100% be paid. So this is a promise to be paid, but the only thing is it is going to be paid later. So in the question, when you say that, okay, this amount will be paid for sure, but it is going to be paid at a later date, it is called DC. So for example, if you say that the amount is going to be paid, let's say 3 years later, the question tells me that a part of the purchase consideration is going to be paid 3 years later. Let's give you how much is going to be paid 3 years later. Let's take an example. So let's say I am given that 133,100 is going to be paid after 3 years. The acquirer tells the equity shareholders, I will pay you this money in cash after a period of 3 years. So you're going to pay this money not now, but you're going to pay this money later. So what I need to do, first of all, I need to calculate a present value of this money. At the first instance, since I'm going to pay this money 3 years later, I will say, okay, if I pay it now, then what is the present value of this money? And for which you need a discount rate that would be given in the question. So let's say the discount rate to calculate the present value is, let's say 10%. So what I will do, I will take a present value of this at the rate of 10%, discounted for a period of 3 years. So which means when you calculate a purchase consideration, the fair value, which is the present value of the DC, is a part of the PC. Mind the words carefully. If there is a deferred consideration, you will consider the fair value of that consideration, which is the present value of that consideration as a part of this. So we can say in terms of DC, we will take the fair value that is present value. So we will take the fair value that is present value of DC as a part of PC. So remember the golden principle, DC is a part of the PC at a fair value, which means you take a present value. So when you take a present value of this 133,100, you discount this at the rate of 10%, it works out at 1 lakh rupees. So PC as a part of the purchase consideration, you will include only 1 lakh as a part of the PC. Now, let's see the entry. As I said, when you're going to look at the journal entry, you need to be careful that am I going to look at the entries before or on or after the date of acquisition? Now watch this carefully. This is the journal entries we are passing. This is before acquisition date, and this is on acquisition date, and this is after acquisition date. Now, when you put the entry on the acquisition date, that is, you give a credit to the purchase consideration, you would have taken the fair value of the deferred consideration. So in this particular entry, the fair value, that is the present value of the deferred consideration, will be taken as a part of the PC. That's one. Later on, post acquisition date, you will do the concept of what we call unwinding of discount. Later, that is after 1 year, 2 years, and 3 years, you got to apply the concept of UOD, that is unwinding of discount. Now, what are you going to do at the end of the first year, second year, and third year? Watch this. What are you going to do at the end of the first year? At the end of the first year, we will put the entry finance charge debit and deferred consideration gets a credit. This is called unwinding of the discount. You took a present value discounting. Now you are going to do compounding, which is called unwinding of discount. So in this case, on 1 lakh rupee, you got to consider a 10% interest. So you got to put an entry, finance charge gets a debit and the deferred consideration gets a credit. Now the deferred consideration, which was recorded at 1 lakh rupee stands in the books of accounts at 1 lakh 10. So you're going to put entries in the post business combination period at the end of first year. A similar entry will be done at the end of second year, but the interest, the finance charge will undergo a change. Now the DC is standing at 1,10,000. So on 1,10,000, you take a 10% interest, that is 11. A similar entry will be done at the end of third year as well. And now the total DC in the books of accounts is 1 lakh plus 10 plus 11. It is standing at 1 lakh 21. Your total DC in the books of accounts is 121 and a 10% interest would mean 12,100. So which means by the end of third year, by unwinding the discount or by compounding the concept, you've reached your DC to the extent of 133,100. So finally, at the end of the third year, you put the entry DC, the deferred consideration gets a debit and the bank gets a credit. And this is to the extent of 133,100. So I think let me put the process again. What is important is you need to be very clear on each of the 7 issues that is it going to impact the entry before, on, or after the date of acquisition. So if there is a deferred consideration, there is no impact on the entries before acquisition date. If in the question you find that there is a DC, there is no impact on the entries prior to the acquisition date. On the acquisition date, when you take the PC, the fair value, which is the present value of DC, is included in the PC. And then starts the journey that is post acquisition. So at the end of each year, you will do the unwinding of discount. So what you did, you first took a present value discounting. And then what you need to do, go back and compound. So whenever in is there going to be a present value concept, a discounting concept, it will undoubtedly lead to unwinding of discount at future dates. So we're going to unwind, or you can say compound, the interest on the cumulative DC. So you calculate the unwinding, the interest on the cumulative DC. This is on 1 lakh, then this is on 1 lakh 10, then this is on 1 lakh 21. You take the unwinding. So you reach the amount which you are liable to pay at the end of third year and it stands discharged. I guess, friends, I am pretty much clear on the concept of DC. Okay, Tanisha, you said, so what has been credited when DC is debited at the end of the third year? The entry is where a DC gets a debit and bank gets a credit. Because you will pay this money in cash at the end of 3 years, DC, debit, bank gets a credit. Correct? I hope, friends, everybody is pretty much clear on this concept of deferred consideration. So moral of the story. What is a deferred consideration? I would say a deferred consideration is something which will 100% be paid. A deferred consideration is something which will 100% be paid, but paid at a later date. So as an acquirer, I tell the shareholders of the acquiree, I will definitely pay you, but not now, at a later date. So what do you need to do? You need to consider the fair value. that is a present value of the future payment as a part of the PC. And once you do that, remember in the post acquisition period, you need to do the unwinding because you did discounting. Now you need to do the unwinding, that is a compounding, and you need to record a finance charge at the end of each year. I hope I am pretty clear with the first agenda, that is DC. Okay, clear. Wonderful indeed. Now let's go to the second agenda with you. This is issue number one. Now let's go to the next one, that is CC. So let's go to the issue number two. Now, many people tend to get confused on the concept of a contingent consideration and a DC. Many people tell me, sir, I am not able to appreciate in the question that it is DC, it is CCS, or it is CCE. Let's make your life simple. So let's discuss the issue number 2 and 3, where we are having a contingent consideration, shareholders' capacity and employee capacity. So what I have done, we'll do a couple of illustrations also with you, because there are few illustrations which are given in the study material, and there are certain bigger questions also which contains the concept of a contingent consideration. Now, to make your life simple, I have created a 3-step model so that you can easily distinguish between DC, CCS as well as CCE. So let's give you a 3-step model. Now watch this carefully. I'm going to give you a simple 3-step model so that you can understand the interaction between DC, CC, and CCS and CCE. Now, one thing, let us understand the difference between a DC and CC, and let's understand the similarity between DC and CC. Mind the words. You need to understand what is common in DC, CC, and what is a difference between DC and CC. If I say I will definitely pay, it is DC. And I say I will pay in the future, it is DC. Even CC is something which will be paid in the future, but it may or may not be paid depending upon the conditions met. So the similarity is a DC-CC is paid in the future. The difference between the two is DC is definitely paid, but CC depends upon the parameters, the conditions are met or not. Because when I say contingent consideration, it means something which is contingent upon certain parameters met. If the parameters get met, I pay. If the parameters do not get met, I do not pay. So I would say in terms of step number 1, what are you going to do? You're going to see, are we going to pay? The step number 1 is to see, are we going to pay later? That is in the future. So the first thing is you need to decide, are we going to pay later? That is in the future. Because if you're going to pay right now, it's neither DC, it's neither CC. So the first focus in the question is to see, are you going to pay later? So the answer could be a yes or no. So if you say, yes, I am going to pay later, it can be a DC or it can be a CC. Mind you, if you say you're going to pay later, this means it can be DC, it can be CC. So what I'll do in both the cases, let's go to the step number 2. But it can be a DC or CC as of now. If the answer is no, it is neither a DC, it is neither a CC. So at the first instance, very carefully see the question that are you going to pay at a later date? If you say no, it's not a payment in future, not a DCCC. If it is a future payment, it can be either thing. Then you go to the step number 2. Now in step number 2, you need to zero down, are you definitely going to pay or is it dependent upon certain conditions? So we will see, is it a definite payment? Are you going to definitely pay? So are we going to definitely pay or not? Definitely means there is a 100% guarantee you'll have to pay it in the future. So when you say that you will definitely pay, the answer is either a yes or the answer is either a no. If you say it is definitely paid, it is DC. The two conditions are met. You will pay in the future and you will definitely pay. It is a deferred consideration. So what do? Fair value of that is taken as a part of the PC. Done. So when it is a DC, you consider, once it is a DC, we consider fair value as a part of PC. The fair value is nothing but it is the present value. So you consider the fair value as a part of the purchase consideration. If you say no, it is CC, then you need to go to the step number 3 to decide further. Is it paid in the capacity of the employee or the capacity of the shareholder? So once you say that it will not definitely be paid, it may be paid, it may not be paid, because it depends upon the conditions. It is contingent. It is a contingent consideration, and we go to the step number 3. Now, in terms of the step number 3, the focus is to decide, is it paid in the capacity of the shareholder or is it paid in the capacity of the employee? Now, please hear me carefully. When as an acquirer, I pay a consideration to the shareholders of the acquiree. The shareholders of the acquiree might be the employees of the acquiree as well. Might be. Now, hear this carefully. I am the acquirer and I pay a consideration to the shareholders of the acquiree. The shareholders of the acquiree might be employees of the acquiree company as well. So when as an acquirer, I give them a payment, I need to see, is that payment given to them in the capacity of the shareholder or is it given in the capacity of the employee? So how would we decide that it is given in the capacity of a shareholder or is it given in the capacity of the employee? Simple. You need to see that what kind of conditions are attached for this payment. If the conditions attached is a future service to be provided by them, as an acquirer, I'm telling them that you need to give me future services in return for this payment, then they're acting as an employee. But if the amount to be paid or paid to them is not dependent upon any kind of future services to be rendered by them, I may ask them to achieve certain conditions, but not provide me future employment. So if the payment is made and I need future services in return, it is in the capacity of the employee. But if the conditions are not future services, then it is paid in the shareholder's capacity. So in terms of the step number 3, you will see that what is the condition. You need to see that is there any kind of a service condition which you have kept with them. You've told the shareholders of the acquiring company that you need to give me future services. If you want to get this payment, work for me in the future. So if you say that yes, there is a service condition. If you say yes, there is a service condition, then in that particular case, it is given in the capacity of employee. But if there is no such condition, the payment is not dependent upon any kind of future services to be given by them, then it is contingent consideration given to the shareholders in the capacity of the shareholder. If it is given in the capacity of the shareholders, I will take the fair value as a part of the PC. If you've given them a payment in the shareholder's capacity, we will consider the fair value of that contingent consideration as a part of the PC. That fair value will be given in the question. But if you say that it is in a part of the employee, it is not to be taken as a part of the purchase consideration. So this is getting technical. Can you please consolidate the 3-step model and tell me difference DC, CCS, CCE? Hear me carefully. Well, you need to remember one thing. If you look at a DC, it is paid in the future for sure. When it is a DC, it is paid in the future for sure. When it is a CC, it is paid in the future, may or may not be paid. So what is the similarity between a DC and a CC? They're going to be paid at a future date. But what is the dissimilarity between a CC as well as a DC? A DC is definitely going to be paid, but a CC may or may not be paid because it is dependent upon conditions which may or may not be met in the future. That's one thing. So when you read the facts of the consideration, you need to see, is the payment going to be made at a future date? No, cannot be DCCC. The payment is made in a future, can be a DC or a CC. So futuristic payment means a DC or a CC. Then step number two, is the payment definitely going to be made DC? You take the fair value, the present value of the consideration as a part of the PC. The payment may not be definitely made because it depends upon the conditions. For sure, it is a CC. Then you need to go to the step number three and see, when as an acquirer, you gave a payment to the shareholders of the acquiree, the shareholders may also be the employees of the acquiree. So they may be acting in the capacity either of a shareholder or the employee. So you can say the shareholders of the acquiree are also the employees of the acquiree. They're both employees of the company and they're shareholders of the company. So when I give them a payment, I need to understand the payment is given in which capacity. If I give them a payment and tell them to work for me in the future, give me future services, I'm giving them payment in employee capacity. Then it's not to be taken as a part of the purchase consideration. But if I'm going to give them a payment and I don't want any future services from them, then it's a payment given in the shareholder's capacity. Then I will take the fair value of that amount as a part of the purchase consideration. So we need questions. I guess you've got the larger concept in terms of DC, CC, E, and CCS. So let's put it like this. If I were to make three sentences, I would put it like this. I will pay for sure in the future, DC. I will pay in the future depends, and it is dependent upon service condition, CCE. I will pay in the future, but it depends and the conditions are not service, then it is CCS. DC part of the PC, CCS part of the PC, both at fair values. And CCE is not a part of the fair value. So now the journal entries as well. So let us do one thing further. Let us now understand in terms of this, that what is the impact on the step number 7, where will the journal entries get affected? So if there is a DC, we've already seen, but we'll just do a quick recap on that. So we can say we're looking at entries before acquisition date, entries on acquisition date, and the entries after the date of acquisition. Now watch this carefully. What do you need to do in terms of the 3 agenda? If there is a DC, if there is a CCS, and if there is a CCE, nothing to be done before acquisition date. On the date of acquisition, would you take it as a part of the PC? Yes, at a fair value. Would you take the CCS as a part of the PC? Yes, at a fair value. Would you take the CCE as a part of the purchase consideration? No. So you need to be crystal clear that when you consider the purchase consideration, DC, yes, at a fair value, CCS, yes, and CCE, no. Now, what do you do post acquisition? Here you apply the concept of unwinding of discount. The entries you've already seen, finance charge debit and DC gets a credit unwinding. Now, the question in this case, we'll see what we need to do. Now, in this particular case, we need to see what is to be done. Aha. This depends upon the financial instrument standard. Oh my God. Now, friends, pardon me for what I'm going to discuss right now, because you will hear me and you will say this man is speaking Greek. He's speaking French. He's speaking German. So please forgive me for what I'm about to speak at the moment. But you'll get a larger picture of this when you come to the financial instrument standards after consolidation. But hear me carefully. I will not be able to give you a logic at this stage because what I'm about to tell you is something based on the concept of financial instruments. So let me explain this to you. Let me explain this to you what we're going to do because you can get questions on this area in India's 103 as well. Now, just hear this carefully. Logics will be given in financial instrument standard. I'm not giving the logic right now. The contingent consideration could be paid either in the form of cash or the contingent consideration would be paid either in the form of equity shares. I am not going to tell you the logic at this stage. You will get the logic 100% in financial instruments. I promise that. I will remind you in the next year. Sir, I will remind you what I said in the next year. The next year is about to come in a couple of days. So I'm going to tell you in the next year the logic, but right now just keep this in mind. If your contingent consideration is paid in cash, it is considered to be a financial liability as per the financial instrument standard. So if your contingent consideration is paid in cash, it is called a financial liability. And the financial instrument standard says that you need to keep recording the change in fair value. And whatever is the change in fair value, please record it in the P&L. They say that a contingent consideration which is paid in cash, any changes in the fair value of that contingent consideration, whether it's an increase or whether it's a decrease, you're going to consider the changes in the fair value and put it in the profit and loss. So if your fair value goes up, you put the entry P&L debit and CC credit. I put it again. If the fair value of that contingent consideration goes up, your liability payment has gone up. You put the entry P&L debit and CC credit. But if the fair value goes down, it's a gain to me, CC debit, and the P&L gets a credit. So any change in fair value, whether it's an increase or whether it's a decrease, you're going to take all that change in fair value in the profit and loss. So subsequently, any changes in the fair value of this contingent consideration is going to be taken as a part of the gain or loss in the P&L. This is what a financial instrument standard tells me. Next, if your contingent consideration is in the form of equity shares, if the contingent consideration is in the form of equity shares, you need to further see that is the acquirer going to give a variable number of shares or is he going to give a fixed number of shares? Now, how do we decide it's variable fixed? We'll see in a question. But if the payment is given in the form of equity shares, you need to see, is he going to give a variable number of shares? So how do you say it's a variable number? I'll tell you. I told the shareholders of the acquiree, I will give you 10 lakhs after 2 years if conditions are met. I told the acquiree company shareholders, I will pay you 2 lakhs after a period of 2 years. Now he says, okay, how many shares will you give me? I say, okay, whatever is the fair value of my share after 2 years, I'll give you as many shares. If the fair value of the share is 200 at that time, I will divide 2 lakhs by 200 and give you 1,000 shares. If my fair value of the share at that time is 400, I will divide 2 lakhs by 400 and give you a total of 500 shares. Which means I will give you the number of share depending upon the fair value at that point of time. The number of shares to be given is not pre-decided. It is not fixed in number, but it is variable in number. If the consideration is paid in variable number of shares, the same concept would apply. It will be treated as a financial liability and any changes in the fair value is going to be taken in the profit and loss account. So we want to look at a question. Don't worry. We'll see a question also, but I'm just giving you a larger concept. If the payment is in cash, it's a financial liability. Any changes in the fair value, gain or loss is taken to the P&L. If the consideration is in equity shares and it is variable in number, you're going to treat it as a financial liability, changes in the fair value again taken in the P&L. But if you pre-decide the number of shares to the fellow, you tell him that I will give you these many shares only. You tell him that I'm going to give you these many shares only, a fixed number of shares pre-decided, then in this particular case, no changes in fair value to be considered. No changes in fair value needs to be incorporated. Nothing is to be done. No subsequent entries are to be done. Sir, please consolidate quickly. If there is a DC, it's a part of the PC and it's going to result in unwinding of discount till it is paid, attributing a finance charge and increasing the DC. Finance charge debit, DC gets a credit. Second, if there is a CCS, then it's a part of the purchase consideration at a fair value. Then you need to decide what is the form of payment. The moment it is CCS, you need to decide, are you giving the money? Are you giving the consideration in cash? If you're giving cash, it's a financial liability. Any changes in the fair value is taken in the P&L. Increase, decrease, whatever. If the payment is in equity shares, you need to see, are you pre-decided the number of shares or will you decide the number based on the fair value after that n number of years? If you're going to issue a variable number of shares, it's again a financial liability, changes in the fair value taken to the P&L. But if you pre-decided a fixed number of shares to be given, then no subsequent entries are required to be done. I know, friends, what I am telling you is quite technical indeed. Okay, so let me, I think, just come back on this. Tansha, you said, sir, will you mind reasoning that why we considered the fair value 1 lakh on the date of acquisition instead 133,100? But 133,100 is the future amount. And when you consider it as a part of the PC, you need to consider the fair value, which is the present value. I cannot record a liability in the books of accounts according to what I will pay in the future. I need to bring it down to the concept that if I pay today, then what do I pay? So the concept of present value is applicable because you need to convert it that if I would pay today, because balance sheet is a position statement as on a particular date. So it should reflect the payment which you would pay today. Correct? And Shruti said in step number 1, with what is that no? Okay, I think let me just go back on the chart. I was just on my own footing right now. So when I say no, it's neither DC nor CC, that means this payment is something else. But that would depend upon the facts of the case. But one thing is sure that it's nothing to do with DC, CC, but what it is that has to be evaluated based on the facts. Correct? And okay, then Shruti, you said, so financial instruments also you will teach? Yes, I will be teaching you financial instruments as well. We've got a long journey. So I'll be covering business combinations and then covering consolidation standards, then coming to financial instruments. We're going to be connected with all these technical standards with you. Trust me, I'm going to make you experts on consolidation, business combination, financial instruments, which is going to be a major chunk as a part of the syllabus. And we're going to make you experts. But terms and conditions apply. T&C apply. Okay, so I hope you got the larger picture. Now, let's come back. I'm just going to take an example very soon now. If it is a CCE, it was not taken as a part of the purchase consideration. Then what do we do? Trust me, friends. If you are making a payment to the employees and the payment is being made to the employees, then I think Ind AS 102 should apply, because if you're giving a payment in cash based on the share price, or if you're giving equity shares itself, it is a share-based payment. So the accounting will depend upon Ind AS 102. So moral of the story, before we go to the questions now, let's consolidate the picture. Now, there is 2 important things which you need to keep in mind. I've given you DC, I've given you CCS and CCE. You need to be very clear, when is it DC, When is it CCE? When is it CCS1? Second, you need to be clear on whether it is taken as a part of the PC or not, and what is the subsequent accounting treatment. So we'll do illustrations on that, but first let's mind the map in our minds. You need to first of all apply a three-step model to decide, is it DC, CCE or CCS? Step number one, the payment is going to be made at a future date. Yes, can be DCCC. The payment will definitely be made DC for sure. The payments may or may not be paid CC for sure. You go to the step number three. Is there a condition that you give me services in return? CCE. There is no condition to give future services, then CCS. Then you go to the picture and decide, are you going to consider DC as a part of the PC? Yes, at a fair value, which is the present value of what you're going to pay in the future. So if there is a CCS, are you going to consider it as a part of the PC? Yes, fair value. If it is a CCE, are you going to consider it as a part of the PC? No. Now, once you've done this, that you've taken it as a part of the PC, what do you do later? DC would result in unwinding of discount, finance charge. CCS depends upon the way the consideration is paid. It depends upon the form of the consideration. If it is paid in cash or if it is paid in variable equity shares, it's a financial liability, and any changes in the fair value, gain or loss, is going to be recorded in the P&L. You keep remeasuring the fair value changes in this liability and put it in the profit and loss account. But if it is a fixed number of shares, then no subsequent accounting is required. And if it is CCE, then in that particular case, all the accounting depends upon Ind AS 102. Now let's do some questions, friends, with you. Let me see if any further questions coming in at this stage. Yes, I think Kriti, you said, so in case of change in the fair value due to variable equity shares, entry should be done after date of acquisition every year. Yes. Till the contingent consideration is discharged, till it is discharged, we will do remeasurements at each date. Correct. Shruti, you said, so why in employees it is not a part of the PC? Well, purchase consideration, what you've learned even at intermediate stage, is what is given to the shareholders. If you're saying that there is a purchase consideration, I acquire the business of another company, I need to pay a consideration to the shareholders. If you make a payment to them, but it is not paid to them in the capacity of a shareholder, but you are giving them a payment in the capacity of the employee, then that payment is not for the acquisition of business, but that payment is made for the services they will give it to you. So you're giving them a consideration not for buying a business, but you're giving them a consideration that they give you future services. Therefore, it cannot be a part of the purchase consideration. Right? I guess I'm fairly clear. Now, I think let's go on to some questions with you. I think we need to apply this to the questions as well. So I'm carrying a few questions with me on this area, and I think let's have a look at this. So I'm carrying a few questions on this concept. I have a few questions which I've added in the assignment. So I think let's come out here. So these are a few questions in the study material as well as in the education material as well, which is based on the step number 5. Okay. So I hope this is pretty much visible indeed. Let me know if I want to zoom it further or this is good to go. You're welcome, beta. So I think this is good to go. Let me now read the questions. We're going to decide in terms of DC, CCE, CCS, whatever. So our three-step model is going to play a picture. So you can start giving answers in between as well. I'm coming to the question number 11. Let me first read the question, then we will apply a three-step model in this case. So let me just read the input. It says K acquires 100% stake in V, a company which is owned by a single shareholder who is also the key MP in the company, a key management person. The person who is a shareholder is also the key MP. He is an employee shareholder in the company, mind you. It's owned by a single shareholder who's also the key MP. So when I acquired a business from the acquiring company, that fellow is the shareholder of the company. He's also the key management person of the company. I need to understand that I'm going to give him a payment in what capacity? As a shareholder or as an employee, KMP. For a cash payment of 20 million and a contingent payment of 2 million. Now there are two payments. You are giving him 20 million right now. So this 20 million which you are giving him right now is supposed to be a part of the consideration, and very clearly it says there is a contingent payment. The terms of the agreement provides for a payment 2 years after the acquisition date if the following conditions are met. The EBITDA margins of the company after 2 years is 21%. You tell the person, I'll give you a payment after 2 years, future. And I will give you this payment if you are able to achieve an EBITDA of 21%. The former shareholder continues to be employed for at least 2 years after the acquisition. No part of the contingent payment will be paid if the former shareholder does not complete 2 years employment. I tell him very clearly, if you do not complete 2 years of employment, I will not give you this payment. Suggest the treatment for the above scenario. I think let's apply the three-step model, though I think many of you have already decided this, and that's wonderful indeed. Very good bit of Tanisha. So let's go to this three-step model and decide the inputs in terms of this. Is this payment going to be made in the future? Yes, 2 years later. So there is definitely a payment to be done in the future. So as of now, I don't know. It can be DC, it can be CC. Let's go to the step number 2. Is the payment going to be definitely made? Is it definite that the payment will be made? No, it's not definite. Because I am putting ifs and buts. I'm telling the person that you need to ensure a 21% target EBITDA. You need to continue for a period of 2 years. So it is contingent in nature. So it is CC. Is there a service condition which you have put in front of the person? Yes. You're telling him that you got to work for 2 years. If you don't work for 2 years, I'm not going to give you the payment. So in this case, we can say it is CCE. If it is a CCE, is it going to be a part of the PC? No. Because if it is paid in the capacity of the employee, it's not a part of the purchase consideration. So what do you do on a subsequent accounting? You would apply Ind AS 102. Okay, I think I got the answer from Tanisha. Very good. I hope others also been able to relate the three-step model. So we have decided based on the facts of the case, it is a payment to be done in the future, but based on ifs and buts. So it is contingent and there is a service condition. Therefore, it is CCE. Nothing is a part of the PC. All the accounting depends upon 102. Okay. Okay, Mansha also tells me step 1, yes, step 2, no, step 3, yes, and that's decided. Step by step makes life simple. Okay, let's try the another question now. Question number 12. It says ABC acquires PQR in September for cash. Additionally, ABC agrees to pay the selling shareholders an amount equivalent to 10% of the profits in excess of 10 crores generated over the next 2 years in cash. At the end of 3 years, I've highlighted that words in red color. So you keep deciding and tell me the answer. So ABC agrees to pay the selling shareholders 10% of the profits in excess of 10 crores over the next 2 years in cash at the end of 3 years. ABC determines the fair value of the contingent consideration liability 1 crores at the date of acquisition. It says a year later, after the acquisition, PQR performed better initially projected, and a higher payment is expected at the end of second year, and the fair value of this financial liability is 2.5 crores at the end of first year. Whether there should be any adjustment in the acquisition accounting, if yes, by what amount? Let's apply a three-step model and also decide the subsequent accounting treatments as well. And Shruti said this relates to 2 million, sir, or 10 million. But in the previous question, that 20 million is paid as of today. So that is a part of the PC right away. But we are looking at the treatment for the 2 million, which is contingent. 20 million is a part of the PC right away and discharged right away in terms of cash. So this treatment is only for the 2 million, which is dependent upon future and conditions. Okay. Now, here again, we are given additionally an amount will be paid in cash at the end of 3 years. Let's apply a three-step model and decide. Is the payment going to be made in the future? Yes, at the end of 3 years. So the payment is definitely going to be made in the future. Yes. It can be DC, it can be CC. Okay, now let's see, is this payment something which is going to be definitely done? No. As it is, the question is very clearly telling me it's a contingent consideration and it's not a payment confirmed for sure. You are telling the person that if the profits go in excess of 10 crores, so it's not a definite payment, contingent in nature. Now we need to see that is there any service condition which is being put in this particular case? Well, the condition is not a service, but the condition is meeting a profits over and above a target profits. You achieve a target profit. There is no service condition. If there is no service condition, it is a contingent consideration in shareholders' capacity. And I think that's rightly said. Indeed, it is supposed to be CCS. Are you going to consider this as a part of the PC? Yes. So we're going to consider this as a part of the PC at a fair value. The fair value is supposed to be 1 crore on the date of acquisition. And he's very clearly told me another thing as well. Once it is supposed to be a CCS, subsequently you need to see the form of the payment. He very clearly tells me this payment is paid in cash and therefore it is supposed to be a financial liability. And if it is a financial liability, subsequent change in the fair value is going to be considered. The fair value at the end of the year is 2.5 crores. So we can say subsequently 1.5 crores gain is going to be taken in the profit and loss account. So we're going to book that 1.5 crores gain from a figure of 1 crore to 2.5. The liability goes up by 1.5. So it's not a gain, I would say it's a loss to me because I'm supposed to make a payment. So my liability increases to the extent of 1.5 crores. You put the entry profit and loss account debit and CC gets a credit to the extent of the increase in the fair value 1.5 crores. Okay, Tanisha, you said so, but there is a lump sum payment at the end of third year. Well, there is a lump sum payment at the end of third year, but he says that you are going to pay what amount? I don't know what is the amount. You to pay the money at the end of 3 years, which means it is futuristic in nature, but it's based on ifs and buts. If it is based on ifs and buts, we need to consider the fair value of that payment, which is based on ifs and buts. A DC is a predetermined amount. A CC is not a predetermined amount. It is dependent upon conditions. So we need to get a valuer who's going to tell me what is the fair value of that contingent consideration to be paid. Right? Okay, so that was one question. So you can see the first question was a case of CCE. The second was a case of CCS and the consideration is in cash. I think we must have a look at a question where it is CCS in the nature of shares. Let's have a look. So let's go to the question number 13, which is a pretty interesting question indeed. It says ABC acquires all the outstanding shares of XYZ in a business combination. XYZ has got three shareholders with equal shareholdings, and two of whom are also senior level employees of XYZ. There are three shareholders. Two of them are also employees of the equerry. One of them is not an employee, just a shareholder. So XYZ has got three shareholders, and two of whom are also senior employees of XYZ and would continue as employee post acquisition of the shares. The employee shareholders each will receive 60 lakhs plus an additional payment of 150 lakhs to 200 lakh based on multiple of earnings over the next 2 years. The employee shareholders will receive a payment, and the payment is dependent upon if you achieve certain target earnings over the next 2 years. The non-employee shareholder will receive a total of 100 lakh. So the two shareholders who are also employees are getting a lump sum payment of 60 lakhs today and an additional payment dependent upon the multiple of earnings. And if you look at the non-employee shareholders, they're going to receive 100 lakhs as of now. The additional payment of each of these employees will be forfeited if they leave the employment of XYZ at any time during the 2 years following the acquisition. No payment will be given to them if they leave the company before the period of 2 years. You're telling them that if you leave, I don't pay you. You need to continue to be in service. The salary received is reasonable for the services. How much amount is attributable to the post-business combination service? I think let's apply a three-step model, though I'm sure you will start giving answers on that. Step number one. Is this payment going to be made in the future? Yes, of course, the payment is going to be made in the future. You're going to make this payment in the next 2 years to come. It's a future payment. We go to the step number two. Is it based on any ifs and buts? Yes. It is dependent upon the earnings. It is dependent upon the future employment as well. So it is based on ifs and buts. It is contingent consideration. Is there a service condition which has been put in? Yes, there is a service condition. Decide, friends, CCS or CCE. The payment is in the future. It depends upon the conditions, ifs and buts, and there is a service condition. And so what is the nature? Can I say CCE? Are you going to consider it as a part of the PC? No. Are you going to apply Ind AS 102 for the post-business combination period? Yes. So that is pretty easy and straight. I hope, friends, you've been able to catch up with the thought process of the three-step model. So your focus has to be very clear. Payment in the future for sure, DC. Payment in the future based on ifs and buts and service conditions, CCE. Payment in the future based on ifs and buts but no service conditions, CCS. And then the subsequent accounting treatment relating to all these parameters. Okay, that's wonderfully given. Great. So now I think let's go to the next question with you. I am now wanting you to go to the next one. Let me zoom this further. I'll have to take it a bit further, just read it along. How would the contingent consideration be dealt with? So I guess let me keep it back out here so that I can save the page. Okay, let me go to the next one. Okay, now we are looking at a very interesting question indeed. This is from the education material. And this question has come a long time in many places as well. As you can see, it came in MTP April 18. It came in MTP October 19. It came in RTP November 22. Let's see if it comes in the exams as well. Okay, step number two is no. Step number two is yes, that's right. It is no, because no. It is definite. Yes, it is not definite. That's right. It is not a definite payment. Correct. Okay, now watch the two parts very carefully. If you're able to do this question, then I think my 3 agenda DC, CC, SCCE is done. Then we're going to discuss the next agenda, that is the fourth agenda. But before that, let's start reading. And I'm going back to the question number 14, two independent parts. Please read carefully. On 1st April 16, A acquires 100% stake in B. As per the terms of the agreement, the consideration is payable in the following two tranches. An immediate issuance. An immediate issuance, if you pay immediately, cannot be DC, cannot be CC, because you're paying it right now. So this is not DCCC. This is a part of the PC right away. 10 lakh shares with a face value 10 is being given. Are you going to consider this as a part of the PC? Yes, at fair value. Because I said the cash which you pay, the fair value of the equity share issued is a part of the PC. So I will consider these 10 lakh shares into the fair value as a part of the PC, and the fair value is given below. Let me read it. The fair value of the shares of A on the date of acquisition is 20. So you're going to consider the 10 lakh shares at the rate of 20 is a part of the PC. This is not a DC or a CC. This is simply a purchase consideration given right away. Then he says a further issuance of 2 lakh shares. 2 lakh shares, the form of payment is shares after 1 year if. Are you looking at the focus point? The form of the consideration is shares, and it says paid later and ifs and buts. If the profits before interest and tax for the first year exceeds 1 crore. So let me, I think, ask you that question. You can decide. Is this payment going to be made in the future? Yes. Is this payment going to be definitely made? No. Is it dependent upon the service conditions? No. It is dependent upon certain target criteria as far as profits is concerned. That is great. So we can say in this particular case, number one, is it a payment to be made in the future? Yes. Is the payment going to be made definitely for sure? No. Is there any kind of service conditions attached? No. So what is the nature? CCS. It is supposed to be a CCS. I think somebody said, Tanisha, CCE. This is not service condition, beta. This is not a service condition. It very clearly says that the condition is a target profit of PBIT. So it's a payment after 1 year future. It is based on a definite payment? No. Depends upon condition. Any service condition? No. No service condition means it is CCS. Are you going to consider this as a part of the PC? Yes. So we're going to consider this as a part of the CC. And what will happen to the subsequent accounting? Let me now ask you. A further issuance of 2 lakh shares. Is it a pre-decided number of shares? Yes. You are going to give 2 lakh share, which is a pre-decided number. If it is a pre-decided number, then no fair value changes needs to be incorporated in this case. So as a part of the PC, you will consider the fair value of this consideration. And what is the fair value of the consideration? It says management estimated the fair value of the contingent consideration is 25 lakhs. So you will take this 200 lakhs as a part of the PC, and you will take 25 lakhs as a part of the PC. Your purchase consideration is 225 lakh. 200 lakhs is the immediate issue of shares, that's one, and 25 lakhs is the fair value of the consideration, and no subsequent accounting is required. No subsequent accounting is required in this particular case, because this is supposed to be a predetermined fixed number of shares, and no fair value changes need to be measured in this particular case. Great. Let's now go to the next part, B. Continuing with the pattern in A above, except for the following. So now he's making some changes. The number of shares to be issued after 1 year is not fixed. If it is not fixed, It is supposed to be variable in nature. If the number of shares to be issued is not fixed, it is variable in nature. Rather, A agreed to issue variable number of shares with a fair value 40 lakhs after 1 year if the PBIT exceeds 1 crore. Now the question rises, what is the status? It is undoubtedly a contingent consideration in shareholders' capacity. So this is definitely CCS. Are you going to consider it as a part of the PC? Yes, I'm going to consider 25 lakhs as a part of the PC. And what about the subsequent accounting in this case? You are giving a variable number of shares, so it will be treated as a financial liability, and any changes in the fair value is going to be taken in the P&L. The fair value of this liability became 40 lakhs after the end of first year. So the subsequent accounting in this particular case is there is going to be a loss to the extent of 15 lakhs, which is going to be taken in the profit and loss account. The liability, which was measured at 25 lakhs on the date of acquisition, stands valued at 40 lakhs after the year end. So the fair value is going to be taken as a part of the profit and loss. It's a loss for me. So you're going to put the entry P&L debit, and contingent consideration gets a credit, and the financial stability stands remeasured in this case. Wow. So I think that takes care of the concept of DC, CC, as well as CCE, CCS. So quick mind map before I think we'll give you a break, friends. So I just need to do a quick recap at this particular stage. So let me do one thing. Let me just add a little inputs at this stage so we can get a quick recap of things. Let me remind you, we are working on the step number 4, that is a purchase consideration with 7 agendas in hand. And in terms of 7 agendas, we've covered 3 agendas with you. So let me just do a quick mind mapping on this. So let's get one thing very clear. When you're looking at a purchase consideration, my 3-step model is the deciding criteria. Now, what is the crux of the 3-step model? I would say once you apply the 3 steps, there is going to be some definite conclusions. Characteristic number 1, there is a payment in the future, and it is not based on ifs and buts. It is not based on any ifs and buts. So the parameter is it'll be paid in the future, and it'll definitely be paid. So this will indirectly tell me it is DC. Second is there is a payment in the future, and it is based on ifs and buts. It is based on ifs and buts. So you need to understand what are the ifs and buts. If you say the ifs and buts is supposed to be a service condition, then it is supposed to be CCE. It is a contingent consideration paid in the employee's capacity. And if you say that there is a payment in the future and it is based on ifs and buts, but this ifs and buts is not any service condition, it is any condition other than service. Target turnover, target profitability, target earnings, whatever, then it is supposed to be CCS. When it is a DC, you take it as a part of the PC. When it is CCE, it's not a part of the PC. When it is CCS, it is definitely a part of the PC. And Preeti, you said, so in case of B, how the number of shares are calculated? We tell the person that I will give you an X amount after 2 years. So whatever is the fair value of the share at that time, I will give you as many shares. As I said in my earlier example, I will pay you 2 lakhs after 2 years. If the price is 200, I give you 1,000 shares. If the price is 400, I'll give you 500 shares. As many shares, so that I'll end up paying you 2 lakh, depending upon the fair value at that point of time. Okay? Okay, now coming to the next agenda. So this was a 3-step model deciding that it is DC, is it CCE or CCS. Next, the most important parameter is When you've decided things in terms of a DC, CCE, and CCS, what you need to keep in mind is there anything to be done before acquisition date, or on acquisition date, or after acquisition date? For all these three parameters is what you need to keep in mind. If it is a DC, if it is CCS, or if it is CCE, in this case, before acquisition, nothing. In this case, take it as a part of the PC at fair value. In this case, take it as a part of PC at fair value. And in this case, don't take it as a part of the PC. That's one. So whether it is to be taken as a part of the PC or not to be taken, that clarity needs to be done. And you're taking DC at a fair value, present value, CC at a fair value, which will be given. Now, what is important is the subsequent accounting. This leads to unwinding of discount. CCS depends upon the form of the consideration. If the payment is in cash, you need to record the fair value change. If it is equity shares variable in nature, you need to record the fair value change. If it is equity share fixed in nature, nothing to be done. You need to be very clear on your thought processes in this particular stage. It depends upon the form of the consideration. Cash, capture the fair value change. Variable equity shares, capture the fair value change. Fixed number of shares, nothing to be done. And if it is CCE, in this case, your subsequent accounting is purely Ind AS 102 based. Right, friends, so that was a quick mind map in terms of what we have learned on the three aspects: DC, CCE, CCS. How do you decide which one is it? And what is the accounting treatment on and post the business combination period? Okay, I hope, friends, you're very clear with this. I think before we take it further, I know what I've discussed since morning is very technical indeed. And Tanisha, so very, very clear, sir. Thank you so much. That's indeed so sweet of you. So I want you, friends, to give me your comfort zone scores on your understanding at this stage, because these are certain crucial parts of the calculation of the purchase consideration, which gives you the insight of what is to be done. So I think at this stage, let's get your comfort zone scores, and I think let's give you a break as well. Indeed, your mind must be getting a bit tired as well. Because after this, I'm going to discuss the other four aspects of the purchase consideration. I think I'm going to start with a little technical discussion that is called a PHI. TC is pretty simple. TC and PHI is what I'm going to decide after the break. So in the meantime, you can keep sending your scores. We'll have a look at them in the break as well. And I think I got my very first score as 9. That's brilliant indeed. Okay, so let's give you a break, friends, at this particular stage. And it's almost around 8:46, so 10 to 12 minutes break, and we'll be back and start back. So enjoy your break, relax your minds. I'll be back. So I guess I'm getting some good scores as well. 9, 9.5, 7, 8, 9. And Shruti tells me, so hats off to you. Well explained things. Three-time explanation, three-step model. You make us learn the concepts. Thank you, Shruti, so much. Indeed, that's so sweet of you, beta. And I think that definitely makes my day as well. Okay, so this was a discussion pertaining to the concept of DC, CCS as well as CCE. Now I'm going to go to another technical concept, which again is slightly related to the concept of financial instruments. And I may not be able to give you much logics at this stage because you'll get more clarity when we come to the subject of financial instruments later. So whatever we need so far, I think let's concentrate on that part. So before I discuss the concept of PHI, which connects with financial instruments, let's go to the fourth agenda, that is TC, that is a transaction cost. So I guess let me just connect you to the concept of a transaction cost. Now, when you're looking in terms of this is the issue number 4, that is we're looking at TC, that is a transaction cost. The question, first of all, arises what exactly is a transaction cost and what is the treatment of this TC? Well, the companies may enter into a deal and there might be some kind of a transaction cost, like, for example, a commission, a brokerage, etc., which is paid. And the person who gets the deal done, you might pay a brokerage or commission to the same. The standard is very clear that as far as a TC is concerned, a transaction cost is concerned, it is never a part of the purchase consideration. So this is not a part of PC. This is not a part of the purchase consideration. So the question rises, what is the accounting treatment? It is considered to be an expense in the period in which it is incurred, what we technically call a period cost. So if there is any transaction cost which is given, it is simply charged to profit and loss account. It is simply charged to the profit and loss account as a period cost. When I use the word period cost, it means it is considered as a cost in the period in which it is incurred. As simple as that. So if the question tells you any kind of transaction cost related to a business combination, never a part of the purchase consideration, simply treated as revenue. Which means, if I'm coming back to the focus points in terms of a journal entry, as I said, for all these 7 issues, you need to be very clear that what is the treatment with reference to the step number 7, that is the journal entry. Am I supposed to do anything before the date of acquisition? No. What am I supposed to do on the date of acquisition? I would say simply put the entry profit and loss account debit and the bank gets a credit. So this is the amount of transaction cost treated as a period cost on the date of acquisition. Anything to be done post business combination? Nothing. So remember one thing, once we're done with all the 7 agendas, I'll give you a consolidated chart, but that's going to be tomorrow, when I will tell you that for all these 7 issues, what entries are done prior to the acquisition date, what entries are done on the acquisition date, and what entries are done post acquisition. So you need to be very crystal clear on the movement of entries prior to acquisition date, on the acquisition date, or post the business combination. So this is treated as a period expense. So this is the only entry to be done. Simple and straight indeed. Okay, I think this would be pretty easy, and I don't think so anybody would have troubles on this area. Now let's go to the next one, and that is the issue number 5. And the next agenda is the issue number 5. And this is what we call PHI, that is previously held interest. This is called previously held interest. So we call it as a PHI, or we call it as a previously held interest. Now, please hear me very carefully, because this is one area which we'll be discussing all through different standards. I'm having a discussion today in terms of business combination. We'll do this discussion even when we come to Ind AS 110, and we'll see a variety of permutation combinations coming in. And since there are a lot of permutation combinations, people do tend to get confused as well. We'll see if we get enough time, though we should, and we will be discussing the concept of step acquisitions and disposals in detail in one devoted class, where when we come to the concept of Ind AS 110. As of now, I'm just considering a few combinations relevant only for the purposes of this standard, that is 103. Now, please hear this very carefully. The concept which I'm giving you is based on financial instruments, so don't get into the logic. The logics will come when we come to the financial instruments, but let me tell you what we need to discuss at this particular stage. When I say PHI, we also technically call this as a case of step acquisitions. So when I say PHI, that you've got a previously held interest, we also call this topic as a step acquisition. So I would say there are a total of two situations which can happen in terms of PHI. Let's say the investor was a passive investor. Let's say the investor was a passive investor, and now he acquired a further stake and he gets a control. Now, if you remember my very first session with you on business combination, I gave you the concept of passive investor means that you've got less than 20% stake. Because I gave you that if you've got more than 50%, it's a control. If it is more than 20 but up to 50, it is a significant influence or maybe a joint control. And if it is below 20%, it becomes a case of passive investor. So which means the acquirer had a percentage of equity stake below 20%. He was a passive investor. And then he acquired a further percentage. So he acquired further shares. And with the help of further shares, he is able to get a control. So let's say, for example, I had a 15% stake. I acquired another 40% stake. 15 plus 40, it make it 55. So I had a previously held interest as a passive investor, and then I further acquired shares, and then I got a control. Now, you would think that why are we discussing the concept of a PHI in terms of a purchase consideration? The purchase consideration will consider not only what you paid to acquire the further shares, but will also consider the fair value of the PHI. So simply put it, I can say when you go to consider the PHI, you need to consider the fair value as a part of PC. In simple words, we can say the previously held interest, because you might have acquired that interest at a particular cost, but PC will not consider what you paid at that point of time. So when you consider the purchase consideration, you're not going to consider what you paid at that point of time, but you need to consider the fair value of that consideration as a part of the purchase consideration. Now, that is one. So which means you're converting from a passive investor to a control. So whatever is the cost of the previously held investment, you will take it at a fair value and take it as a part of the PC. You don't need to consider the cost paid at that time as a part of PC. You need to consider the fair value as on the date of acquisition as a part of PC. Another thing, when you were acting as a passive investor, you were accounting things under Ind AS 109 financial instruments. So sometimes you might get independent questions where he says that what is the accounting entries to be done when you're going to switch over from a passive investor to a control situation. So we'll discuss that as well. As of now, for 103, you just need to be clear that any previously held investment which was accounted under Ind AS 109 is now to be fair valued and is to be taken as a part of the PC. But what are the accounting entries we'll discuss? Next. The situation number two is that in this particular case, you had a significant influence. The case number two is that you've got a significant influence over the investee company. The acquirer had a significant influence over the acquiree in the past, which means it was 20% or more, but less than 50. It was 20% or more, but less than 50%. So it could be a case of a significant influence. Then you further acquired shares, and by further acquisition, now you get a control. So this is called a step acquisition as well, that you had a certain percentage stake in the company and then you acquired a further stake in the company. Now, in this particular case, let's say, for example, you had a 25% stake, you acquired another 40% stake. So now you get a 65% stake and you get a control. So the concept of PHI means that you already had a certain percentage stake in the acquiring company. It was either a case of passive investment below 20, or it was a case of a significant influence that is 20 and above, and but below 50%. And even in this case, the fair value of the previously held investment is going to be taken as a part of the fair value. So the basic thumb rule is that when you calculate a purchase consideration, if you've got any previously held interest, take the fair valuation of that previously held interest on the acquisition date and take it as a part of the purchase consideration. Next. In this case, again, we can say that we must have been doing the accounting earlier as per Ind AS 28. Because when you got a significant influence, if you remember the chart which I gave you on day one of business combination, I said that if there is a significant influence, you would be preparing a consolidated financial statements as per Ind AS 28. So this existing investments would have been accounted under Ind AS 28, and this existing investments would have been accounted under Ind AS 109. Now, I'm going to go slightly out of this standard and explain you that if you were accounting under 109 and you come under 103, if you were accounting under 28 and you come to 103, then what is going to be the accounting treatment? Because sometimes you might get a question in the exam where you get an independent question just on the concept of step acquisition. The examiner gives you a data in the question that this was the investment accounted earlier under 109, and with a further acquisition, please give me the accounting entries for the changes. The examiner might tell you that you were doing the accounting under Ind AS 28 and now I am getting a further stake in the company. So what are the accounting entries to be done? For the purposes of purchase consideration, that is step number 4, the only thing which you need to know is that you need to consider the fair value of the previously held interest as a part of the purchase consideration. See what is the fair value on the date of acquisition for the PHI, and that's a part of the PC, which will be easily given in the question. So I think this part must be pretty much clear what we've discussed so far. Let me still see if there is any questions. Nothing so far. Great. Now, let me come to the technical discussion, friends. You need to watch me carefully. I don't know how much are you conversant with the concept of FVTOCI, FVTPL, FPTOCIR, FPTOCINR. Sir, what are you saying? Okay, let me ask you, friends, are you conversant with the concept of OCI with a recycling, OCI with a no recycling? Because even if not, don't get worried. I will give you a larger picture when I come to the financial instrument standard. When I'll come to the discussions on Ind AS 109, I will give you the larger picture in terms of what FPTPL or FPTOCIR or FPTOCINR implies. But as of now, do you have some basic understanding? Let me just get that from you. So what do I presume? Nothing? Or just a basic understanding that if you've got a fair value through other comprehensive income, do you know a little idea on what do you do? Okay, so I think before we get your inputs, let me take it further. So I am now going to give you some input discussions. Even if you don't have a background, no worry. We will see what is the accounting treatment we got to do in these two cases. So I'm taking you to the concept of a switchover. So we're going to consider the two situations and we're going to see what is the accounting treatment in terms of the two situations. Okay, so let me begin with the two situations. What are going to be the independent accounting entries? And I think I got the answer. No idea, sir, at all. Okay, no worries on that. Let's, I think, concentrate on this part. I'm looking at a case when you convert from a passive investor into the case of a control. I'm looking at a situation where from a significant influence, you switch over to the concept of control. Now, please hear me carefully. Don't get worried on the logics, why we are doing all that, because you'll get a good insight when we come to the financial instrument standard. So as of now, just accept the facts. So don't worry, the logics will come later when we understand financial instruments. Now, when you were a passive investor, we were doing the accounting under Ind AS 109. Ind AS 109 makes it very clear. Please hear the words very carefully. Ind AS 109 makes it very clear that if you invest in the equity instruments of another company, you will measure the investment. As per Ind AS 109, you will measure this investment at FVTPL, or it is measured at FPTOCI, which is NR, no recycling. Don't get worried, friends, on the terminology, on the logics right now, because we can't keep this topic pending. So we need to discuss it at this stage, but you'll get the logics once we come to financial instruments. So just accept the facts. Ind AS 109 makes it very clear that as a investment, as a passive investor, if you invested in the equity instruments of a company, you will measure the investments at FPTPL. Now, what does FPTPL means? You will measure the investment at a fair value, and then any changes in the fair value are taken in the P&L. The company will measure the investment at a fair value initially, and then every balance sheet date, any changes in the fair value are taken in the P&L. So when I say FPTPL, it means the changes in fair value are going to be put in the profit and loss section of the income statement. If there is a gain, if there is a loss, irrespective whether there is an increase or decrease in the fair value, you will put that gain or loss in the P&L. That's why we say it's a fair value through profit and loss. So the word is called FVTPL, a fair value through profit and loss. That means any change in the fair value of the investment is going to be taken in the profit and loss section of the income statement. Similarly, if you're considering the investment as FVTOCI, this means the investment will be taken at a fair value, and any changes in the fair value at every balance sheet date is going to be taken in the OCI section. So in this particular case, if there are any changes in the fair value, it is going to be taken in the other comprehensive income section. The examiner under Ind AS 103 has to clearly tell you that this investment is accounted at FPTPL or is it accounted at FPTOCI. I will not be asked in the exam whether this investment earlier was accounted under FVTPL, a fair value change rooted in the P&L, or FPTOCI, a fair value change entered in the other comprehensive income section. That's one. Next. Keeping this background into account, if you remember, I said the PHI is going to be taken at a fair value. So the question arises, you have an investment in the books of accounts already, and you need to take that investment at a fair value on the acquisition date. So where would that gain or loss enter? Simple. So if your investment is measured at FPTPL, If your investment is already accounted under FPTPL, any change in the fair value, so whatever is the book value of the previously held investment and the fair value of this previously held investment, the difference between the fair value and the book value of this investment on the date of acquisition will be taken in the P&L. Whatever gain or loss is there. So if the value of the investment goes up, you put the entry investment debit and P&L credit. If the value of the investment goes down, you put the entry P&L debit and investment credit. And mind you, these entries are being done before the acquisition date. Remember the 3 blocks I gave you in terms of the step number 7. So what do you need to do before the acquisition date? If you've got any previously held investment, then any change in the fair value on the acquisition date and the book value on the acquisition date, you're going to take that gain or loss in the profit and loss account, provided the investment is measured at FPTPL. But if the examiner says that the investment is measured at FPTOCI, that is with no recycling, in this particular case, again, you will compare the fair value versus the book value on the date of acquisition, and any gain or loss will be taken in the OCI. So the fair value of that investment on acquisition date versus the book value of that investment on the acquisition date is going to be taken to the P&L or is going to be taken to the OCI, depending how it was accounted under 109 earlier. So the only thing which you need to remember is that your existing investment, your previously held investment was accounted under 109 as per which method? If it was accounted under FPTPL, put the gain or loss in the P&L. If it is accounted under OCI, put the gain or loss in the other comprehensive income. So the examiner could be interested in finding out, do you know the entry for the revaluation of the previously held investment? Investment to P&L or vice versa? Investment to OCI or vice versa? And these entries will be done before acquisition date. That's one. Second, now coming to the next agenda, when you were having a previously held interest, and that was a case of a significant influence, you were doing an accounting under Ind AS 28. You were doing an accounting based under Ind AS 28. And under Ind AS 28, there is a specific method of accounting for the investment, and that is called an equity method. So you're going to see later when we come to the consolidation standards that when you get a significant influence over a particular investee, you follow what we call an equity method of accounting. So in this particular case, when you were applying the concept of Ind AS 28, then we would have applied the concept of equity method of accounting. We would have applied the concept of equity method of accounting. Now, in this particular case, if you would have applied the concept of equity method of accounting, trust me, what I'm going to do now, I'm going to consider the fair value of the previously held investment versus the book value of this investment on the date of acquisition. And any gain or loss in this case will be taken in the profit and loss account. Simple. So if you were accounting it as an investment, which was a previously held investment under 28, any changes in the fair value on acquisition date and the book value on the acquisition date is going to be taken in the P&L. Which means it is simple. If it was a passive investment accounted under FPTPL, gain loss in the P&L. If it is a passive investment accounted under FPTOCI, gain loss in the OCI. If it is a significant influence, then the fair value changes in the P&L. So you can say the fair value changes enters in the P&L, except if it was a case of passive investment where you were to take the fair value change in OCI. That's not the end. In this standard, the examiner could also testify more things as well. Now, I'm feeling a little apprehensive because you've already said that we do not know what is recycling and what is no recycling. I guess, friends, you must have done that in Index 1, presentation of financial statements, understanding the concept of what is recycling and no recycling. If not, I think I'm entering into a dangerous zone of discussions. And if yes, please tell me yes. I would say a yes only. Don't say a no. You know the concept of recycling and no recycling because I need to give you another accounting treatment pertaining to recycling and no recycling. Okay, Tanisha, you said so, but practically, how do we make out whether it is FPTPL or FPDOCI? Well, that we'll understand when we come to the financial instrument standard. What are the parameters under 109 which tells you whether we'll account it under PNL or OCI? Those parameters you will learn. As of now, in 103, assume it will be stated in the question. I don't need to decide, but how do we decide practically as well as from the examination point of view? We'll understand when we come to 109. Okay, so I think I got a yes, that yes, we know what is OCIR and what is OCINR. That's great. Now, let me add a little more discussion, friends, at this particular stage as well. Please hear me carefully. The fair value changes entered the P&L, the fair value changes entered the OCI. Now, I'm talking of this case. I'm talking of this case. When the investment was accounted under FPD OCI, there must be accumulated changes which must have been taken in the OCI. Because every time the fair value changes were parked in the OCI, you know that from the OCI, they are taken in statement of changes in equity. Because whatever is taken in the other comprehensive income is then transferred and accumulated in other equity, that is in the statement of changes in equity. So now the question arises, what do we do with this accumulated OCI balance? The examiner would also tell you that previously, when this investment was accounted under FPD OCI, there is an accumulated OCI balance as well that will be transferred simply to the retained earnings at this stage. So if he tells you that there is an accumulated balance of OCI in the other equity component, you just need to put that in retained earnings. Because now the relationship is changed from a passive investment to a control. So any previously accumulated balances in the other equity, which has been parked in other equity, is going to be simply transferred to the retained earnings. One. I'm now coming to this part. If you're accounting the investment under equity method, here again, due to the application of equity method, he will again tell you that there is an accumulated OCI balance as well. So here again also, he will tell you that due to equity method application. Now, what is the application of equity method, which we'll see later when we come to consolidation standards. But due to the equity method application as well, there might have been some changes accumulated in the OCI. Now, in this particular case, what we will do, we will do a scrutiny of these changes. So whatever is accumulated in the OCI, I'll take an example also after this discussion. I will do a scrutiny of the changes accumulated in OCI and identify that out of this, what is no recycling and what is recycling portion. The examiner will tell me that due to equity method application, these are the balances accumulated in OCI. So I will say, okay, let me scrutinize the fact and identify what portion is related to no recycling and what portion is related to recycling. The portion related to recycling will be transferred to the retained earnings, and the portion related to recycling will be transferred to the P&L. Sir, we are not able to understand. As I said, this is a knowledge based on the OCI concept and a bit on the concept on financial instruments, but majorly this discussion of R&R is based on Ind AS 1 presentation. But even if you're not very comfortable, don't get worried. I will give you a deeper discussion of these things when I come to the financial instruments. You will get the entire concept of OCI, R&R, everything. So as of now, what you need to remember, let's do a crux of the situation. I would say there are a total of three situations in PHI. I would say there are three situations in terms of PHI. To put it afresh, let's quickly do a mind mapping. If I look at the mind mapping in terms of PHI, before I take you to the practical illustration, so there are a total of three situations, number one, number two, and number three. You just need to remember what is to be done. The logics will be done later because at this stage, I can't take you to the OCI concept. Otherwise, business combination will take a back seat and I'll start discussing OCI. So I think we'll understand the logics later, but just remember what is to be done. Now, see, watch this carefully. If this chart becomes clear, you are sorted. So now see what is to be done in this particular case. There are a total of three situations and see what you need to do in these situations. One is you were a passive investor. You were a passive investor and you're turning to a controlled situation. The second case is you are a passive investor. You are a passive investor and you are turning to a controlled situation. The third is you've got a significant influence and you're turning to a controlled situation. So you need to carefully see what is the category of situation. So you will look into you're a passive investor, which means it was below 20. It was below 20 and you turned to 50% plus. Here also we can say we were below 20 and you turn to a situation of 50% plus. In this case, it was either 20 or 20% plus, and you turn to a situation of 50% plus. So first, identify which case are we falling in. First, identify which case are we falling in. So this is like the step number one. Wow. This is like the step number one. First, identify the case. Logics we can see later because at this stage is important to understand what is to be done. Logics also will come, but we need understanding of OCI financial instruments later. Step number one, identify the stage, and then we go to the step number two. And then we go to the step number two. And then we'll go to the step number three. So in this case, again, you would apply a three-step model. Oh my God. So how do you keep creating three-step models on every little thing? DC, CC, ECC, S, three-step, TC not to be taken as a part of PC, and PHI again, we've got a three-step model. So first identify the case. Now, step number two, you need to be careful where the fair value changes will be taken. So the examiner will tell you that in this case, we were accounting under FPTPL or we were accounting under FPTOCI. And here we were accounting under equity method. So you need to be clear in which situation the book value versus the fair value is taken where. If it was accounted under FPTPL, take the fair value change P&L. If it is accounted under OCI, fair value change OCI. If it is accounted under equity method, again P&L. Life simple. So you looked at the case and then in step number two, you decided where the change in the fair value is taken. The book value of the PHI and the fair value of the PHI is taken to the P&L, OCI, P&L as the case may be. Then you go to the step number three. Then you go to the step number three. You need to watch out if there is any accumulated OCI balances available or not. The examiner would tell you that due to the previous application of these standards, there may be accumulated OCI. In case number one, there will be no accumulated OCI for sure. Because you were taking FPTPL, so no accumulated OCI balances will exist. Nothing to be done in step three. In this case, there will be accumulated OCI balances, and trust me, this accumulated balances in OCI, whatever accumulated OCI balance is there, just simply transfer to the retained earnings. Thank you. So whatever is the accumulated balances in OCI is simply to be transferred to the retained earnings, because this is no recycling. Because this entire accumulated balances is with no recycling, and when there is no recycling, it is never transferred to the P&L. Whatever is accumulated is internally moved from the OCI tab to the retained earning tab. So the accumulated balances will be simply taken to the RE. Now comes the third situation when you applied Ind AS 28. In this case, accumulated OCI balances will be given, and you will have to make a scrutiny of this accumulated balance. Your knowledge of Ind AS 1 will be required, and you will say, okay, in this accumulated balances, what is the portion which is no recycling? Let me put it in retained earnings. What is the portion which is related to recycling? Let me put it to the P&L. So you'll have to go through the component, the accumulated OCI, and scrutinize. Is it no recycling? RE. Is it recycling? P&L. How do we do that? I'll explain with a practical illustration. So get this three-step model clear. Identify which situation I'm falling into. Accordingly, the gain or loss in the P&L or OCI, and accumulated balances will not be there if it is accounted under FPDPL. Accumulated OCI in the second case, all in retained earnings. This case, scrutiny relating to NR in retained earnings related to R is taken in the PL. I hope, friends, now I am pretty much clear on the agenda. Got it? Clear? Wonderful indeed. Okay, there was a question which I think, Kanisha, you've already got it. Okay, great. Now, friends, let's do a practical illustration with you on these combinations with you. So let me do one thing. Let me just take you back on the questions in the study material. So there has been some wonderful questions given in the study material on the concept of PHI. So we're going to consider the question on a PHI with you. So let's go to the example number. Let's go to the illustration number 11. So let's have a look at illustration number 11. I hope this is visibly clear. Yes, I think so. So I'm now going to read this example, this illustration 11. We'll see which case is this and apply a three-step model. Let's go through this very carefully. It says on 1st April X1, PQR acquired a 30% ordinary share. 30% means you got a significant influence over the company. So on 1st April, the company PQR acquired 30% shares of XYZ for 8,000 crores. So this is the book value of the PHI. PQR accounts for this investment using equity method as prescribed under Ind AS 28. Step number 1, which case is this? It is the third case where you were accounting under equity method 28 and you got to convert to control. On 31st March X2, that is the end of the year, PQR recognized the share in the net assets using equity accounting as follows. So as per equity method, you go to see in Ind AS 28, when you apply the equity method, you would give a credit to the P&L, you will give a credit to the OCI. So he says the credit given to the profit and loss is 700. And the difference, the amount which is credited in the OCI is 150. Due to the application, now mind the words, due to the application of the equity method, there is an accumulated OCI balance. Now, I think for those who know the concept of R and R, you can decide. There is a share exchange difference. The share exchange difference arises on account of Index 21. Is it taken in OCI R or is it taken in OCI NR? Let me get the answers from your side, friends, on that. Tell me, when you apply, because you've done Index 21, so when you apply the concept of Index 21 and there is an exchange gain or loss arising on account of investments, where do you take that gain or loss accumulated in OCI R or accumulated in OCI NR? Also decide. There is a revaluation reserve of PPE which arises on account of Index 16. Because Index 16 considers a PPE at a revaluation model and the fair value gains are taken in the OCI. Is that R or is it an R? I didn't get even a single answer so far. So I think let me answer that. So in Ind AS 21, the amount is recycled and in AS 16, it is not recycled. So when any fair value changes are taken in terms of OCI, exchange gain or loss in terms of Index 21, it is OCI recycling, which means to be taken to the P&L at a later stage. And in terms of Index 16, it is taken in terms of R. Okay, I think now I got the answers. That is correct. And this would have been no recycling. So I know that this is the accumulated balances in OCI due to equity method. So 100 is recycling to be taken to the P&L and 50 is no recycling to be transferred to the retained earnings. Let's go further. The carrying amount of the investment in the associate is 8850. So they would have done some accounting, which we'll see later. But this is the book value of this investment as on the date of acquisition. So 8850 is the book value as per equity method of accounting. Let's read further. So we have acquired some investments and now it tells me a little further as well. Let's have a look and then we'll see the entries as well. On 1st April X1, PQR acquired the remaining 70% for cash consideration and we are given the fair value of that interest already owned and the fair value of the net assets is given. Now, what do I need to do? Let me apply my three-step model and give you the entries. Then we'll look at the answer later. So let me first give you the insight and watch me carefully. So I am first going to apply my three-step model. I'm going to first apply my three-step model. And I trust you, friends, I would advise that today's class must have been very technical. Yes, sir. First class was a little technical, second was a little more, third is little more. And now it's not going to be a little more. We've reached the pinnacle. So we're now going to maintain a level and slightly come down in the next two classes. You know, my teaching style is also like a normal curve distribution, the bell-shaped normal curve. I start things with a very ease and then we go to the peak, maintain the peak for some time and then we slightly come down. So I have already reached the peak levels in terms of things. We're going to maintain that peak a little tomorrow and then we're going to go and come down on the standard. So if the need be, since it's a video available on YouTube for your access, you could, again watch this video. Maybe you could apply your 2x, 1.5x, whatever comfortable, and you could watch this as a revision again. Trust me, it helps. I think that is the advantage you're getting in terms of the classes of the ICAI, that you can attend them, first of all, absolutely free. And then you got this access as a database to look at back in them and clarify things later. That's a real advantage. So let's go to the three-step model and let's have a look at the three steps to begin with. Then we're going to see the entry. Now, the step number one, which case is this? It is a conversion from a significant influence, that is Index 28, to a control situation. very clearly identified that we are moving from equity method of accounting to a control. We had a 30% stake. We acquired another 70% stake and it became a 100% stake. Number two, in this particular case, you now need to consider the fair value versus book value where P&L. What is the book value of this investment? The book value of this investment is 8850 crores. And what is the fair value of this investment? It is 9,000 crores. So you need to consider the PHI, the previously held investment at a fair value. There is a gain. So I put the entry investment gets a debit and the P&L gets a credit, and that is to the extent of 150 crores. So this is the entry which we have done for the revaluation gain. The previously held investment is bought at a fair value on the acquisition date. So any gain or loss is taken in the P&L. Done. Now we'll go to the step number 3. Let us see what is the balance accumulated in the OCI. Now, we've already seen the balance accumulated in OCI is 100, which is R, and it is 50, which is NR. So we know that we've got accumulated balances 100, which is supposed to be recycled, and 50, which is not to be recycled. So let's put separate entries for this purpose, and the entry is going to be recycled portion. The OCI gets a debit, and this is going to be taken to the profit and loss account, that is 100. So whatever is the balance accumulated in the OCI related to the recycling, put it to the P&L. And then for the portion which is no recycling, that is taken to the retained earnings, and that is to the extent of 50. So my advice is these entries are being done when it is being done before the date of acquisition. So in my step number 7, these entries are done before the date of acquisition. This entry as well as these entry are all done before acquisition date. You revalue the investment 1. Then you take your OCI scrutiny and take it to the P&L or RE number 2. Then I would advise go to the entry on date of acquisition. So at this stage, you can now see the entry on the date of acquisition. So as I said in step number 7, you need to see entries before, you need to see entries on date of acquisition. Now for the entry on the date of acquisition, you need to put the acquisition accounting entry. And I would say when you're putting this acquisition accounting entry, you know the entry net assets at a fair value. Now watch this carefully. You're going to put the entry net assets will be taken at a fair value. It says fair value of the net assets is 30,000. Then you consider the purchase consideration. This is including the PHI. This is including the PHI at a fair value. So what did I pay for 30%? I paid 8,000, but that's way back. Now the fair value of the PHI is 9. And how much did I pay for the remaining 70%, 25,000 crore? So you take the fair value of the PHI, 9,000. You take the consideration paid for 70%, 25,000. So 9 plus 25, that makes it 34. And there is no NCI. Because you've already acquired a full stake. Since you've already acquired a full stake, there is no NCI, 100% belongs to me. So let's get the balancing figure, that is goodwill. The goodwill balancing figure comes to 4,000, that is the entry. Now, if you look at the entry which is done in the study material, it is exactly same, except that they've clubbed all these 3 entries in one. My advice is, it is good that you go step by step so that you don't go wrong. Revaluation of the investment 1. Accumulated OCI scrutiny and entry 2. And these are entries before acquisition date, and then put this entry. Now let's have a look at the entry which is given out here in the solution. Absolutely similar. You can see the net assets have been given a debit of 30. And you can see the cash consideration is 25. And you can see the previous investment is given a credit at a book value. And this amount is 50, which is taken in the, sorry, this is not 50, not this 50. So previously held investment, the gain is 150. So this 250 is including that 150. So 8850 is the previously held investment. The gain enters in the profit and loss out here. Then you can see there is a gain on the previously held investment as well. Sorry, this 50 is nothing, but this is this portion. That is no recycling. And this includes another 100, which is recycle. So this 250 is consisting of this amount of 100 and this amount of 150, that makes it 250. And this 50 is nothing but appearing out here. And this foreign currency and PPE, this was the accumulated OCI balances given. And you get the goodwill as a balancing figure. My advice is, if you're going to pass a consolidated entry, you might tend to become confused because you're not very experts at this stage. So my advice is go for separate entry. Revaluation of the PHI, put the entry before acquisition date. Accumulated OCI, do the scrutiny and put it in the P&L or RES, the case may be, that is before acquisition date, separate. And then you go for your acquisition entry when net assets are taken at a fair value. PC, including the PHI, is taken at a fair value, and you get the balancing figure goodwill. Life becomes simple. Right? I hope I am pretty much clear, friends, at this particular stage. Okay, Tanisha said, sir, had the gain been only 90, then it would have been packed over the journal entry as well. Well, as I said, don't put a consolidated entry. It can tend to be confusing for you. As I have said, and I would insist and request that do one thing, do a separate entry for revaluation of the PHI, 1. Do a separate entry for the scrutiny of the OSI, 2. And then you put the entry on the acquisition date. Life will be much simpler and easy. And he said, sir, again, there is a 3-step model. Isn't that so? Yes, of course. There is, again, a 3-step model in terms of entry as well. Step number 1, then step number 2 entry, and then the step number 3. But I think I'm not putting that steps. This is my 3-step model in terms of PHI. Identify the case, then see the revaluation gain to be taken to P&L OCI, and then the scrutiny of the accumulated OCI, as I put across earlier as well. Okay, so we are done with 5 agendas in terms of PC. DC done. CCE done. CCS done. And then TC done. And then a PHI done. Okay, now let's do one thing, friends. Quickly, let me just consolidate the learnings in a simple chart at this particular stage so that you are absolutely clear in terms of things. Now, watch this carefully. This is a super summary of my discussions, what I've done today. So now I'm left with 2 discussions, which of course we'll do tomorrow. That is SBP and pre-existing relationship. But before we end, I think let me just quickly consolidate the inputs out here. This is a super summary. This is a super summary in terms of things. I'm just going to tell you what is to be done at each stage. That's it. So the larger picture is we are looking at the purchase consideration, entries before, entries on, and entry after date of acquisition. So let's see what are the key aspects, what we've learned. Now see this carefully and you'll get the results. Today we talked of DC, we talked of CCS, we talked of CCE, we talked of TC, and we talked in terms of PHI. So a total of 5 agendas, what we have discussed. So let's, I think, take it one by one with you. When it is a DC, any entries before acquisition? No. And on the date of acquisition, it's a part of purchase consideration at a fair value. And what do you do later? Unwinding of discount, attributing a finance charge in this particular case. Next, CCS, anything before acquisition? No. Is it a part of the purchase consideration? Yes, at a fair value. And in this particular case, if it is in cash or if it is variable equity shares, you need to consider the changes in fair value. And if it is fixed number of equity shares, then nothing is to be done. That's the focus point. Your mind needs to be very clear because there are a lot of things to be remembered. Your mind needs to be very clear what is to be done at each stage. CCE, nothing before, not to be taken as a part of PC, simply the application of Ind AS 102 post the business combination period. Next, TC, nothing before, and it is simply debited to the profit and loss account, nothing to be done later, a period cost directly. Then in terms of PHI, yes, we need to do something before. And you need to revalue the investment. You need to revalue the investment, take the gain or loss in the P&L or the OCI as the case might be. And you also need to consider the scrutiny of the accumulated OCI as well. So if there is a PHI, you need to remember revaluation of the previously held investment at a fair value with a gain or loss taken to the P&L OCI. And then accumulated OCI to be scrutinized. Then on the date of acquisition, it's again a part of PC and it is taken at a fair value. Anything to be done post-acquisition? Of course not. Anything to be done post-acquisition? Nothing. So this is the chain of thought. You need to be very clear on each and every component of the PC. What is the impact before? What is the impact on? And what is the impact post the date of acquisition? I hope, friends, you've taken a note of this. And this gives you a clarity on all the 5 agendas. Now we are only left with the concept of a share-based payments. And we are left with the concept of a pre-existing relationship. And this, of course, we'll be discussing tomorrow with you, the concept of SBP and the concept of share-based payments, based on which I'll be doing a comprehensive question as well. And so I think what I'll do these 2 discussions and then do a simple question on acquisition accounting, because tomorrow I'm also planning to, start and kick off the concept of reverse acquisition. Then in the next class on Tuesday, we can pick up the concept of common control transactions and the time will permit, and we can do a little more practice thereafter. And of course, after all this is done, then your extensive practice would also be required. Once you're able to do all that, you'll feel very, very comfortable indeed. I know the inputs which I've given you today has been very, very heavy indeed, but I'm sure at the same time, you must have picked up the concept well as well. Okay, and Tanisha says, superb summary, sir. It's like icing on the cake. Thank you so much. Thank you, Tanisha. Thank you so much indeed. That's so sweet of you, beta. And I think so sweet of all of you. So thank you very much indeed. Let's see if any further questions coming in from your side. Otherwise, I think let's call it a day. You need a mental rest. And please do revise all what we have done today, because tomorrow we're going to do a larger question as well. And all these concepts, what we've learned, are going to be extensively used as well. So let's see if any further questions coming in further at this stage. Surat sir, aaj ki class was technical pro max. But if you've understood the concept, then I think it's great. I know it was quite technical indeed. That's what the disclaimer I made at the start as well. But what is important is if you've got the understanding, that's brilliant indeed. Right, friends. So I think that's all what seems to be here for today. So thank you very much indeed, friends. So I think it's time to bid goodbye to you. Thank you, all of you. See you tomorrow. We've got an extra class tomorrow. So we'll continue with this discussion tomorrow as well. Thank you. Bye-bye and take care.